All right, good afternoon, everyone. I'm Matt Dana, the managing partner of Dana Whiting Law, and I'm here with my partner and founder, Mr. Trevor Whiting.
Good morning, Matt.
And Trevor, when we get together, bad things happen, right?
We start.
Maybe good things happen.
Good things happen for a lot of people, and bad things maybe for others.
Well, good things happen for a lot of people, and bad things happen to the IRS.
That's
How
right.
about that?
Yeah.
Trevor and I love our country and we love the IRS, but we believe in paying your fair share means you take a look at every code section, every court case, and every regulation that we can apply.
Yeah.
We never use the term manipulate, do we?
We don't. Yeah, we don't do tax avoidance. We do tax minimization strategies and do some good tax planning.
There's plenty of provisions in the tax code that allow you to do appropriate planning, and I think, Trevor, on a lot of our past videos, I think people are getting familiar with this word. We call it a squeeze. Just let's refresh everybody's memory what a squeeze is.
Yeah, we use a squeeze in our planning as a way to discount the value of assets that would otherwise be subject to a gift or estate tax.
Yeah.
And so we squeeze it we transfer assets into a limited partnership or an LLC, and we put provisions into the documents controlling those entities that say that there are restrictions on control, there's restrictions on marketability of those interests. And so when we appraise and value the assets or the value of the interest in the LLC or partnership that's transferred for a gift or at death, then they're going to be discounted. And so we take a bigger chunk of assets and we squeeze it down to a
yeah, like if
value.
we had a $14 million exemption, we can squeeze 19 or 18 million into a 14 million. It's kind of like wearing that girdle.
That's right. Yep.
Yeah. Not that you would know.
Not that I would know, but I've heard.
All right. So we know what a squeeze is. Now, the most common recipient of a squeeze would be some type of a green box. We talk about in our videos green boxes, and we know green boxes are free of estate taxes. So we want to squeeze into a green box, and typically that green box is a spousal trust, a slat, talked a lot about those, or it's a green box for the kids. I want to talk today about the most common green box we're doing right now is the slats. And this is a hot topic, Trevor, because as we know, these exemptions are going to roll back the end of next year. The $14 million exemption is going to roll back to $7 million. And if you're a husband and wife, both of your exemptions are going to roll back. But we have strategies to lock that exemption in, and those strategies, you have to do one exemption this year, which is 2024, and one exemption next year, 2025. And so time is of the essence here, what we're talking about. The clock's ticking. We're getting close to November 1st. We got 2 months left to squeeze into a spousal trust, a spousal green box, to lock that exemption in. Now, Trevor, quite frankly, I'm losing sleep at night wondering if I can get this done for the number of clients that we have. With these videos, we're creating almost one brand new client every single week that's over $50 million or over $100 million. And we're starting to line them up to try to get one of those slats done this year. And these discounts can take time because you have to create some type of a wrapper or a partnership. And a lot of times what you're wrapping into these things would be real estate. And with real estate, you might have mortgages where you need bank approval. With real estate, you might have partnership agreements where you need partner approval. And I think right now, Trevor, it's just virtually impossible for us to think about a squeeze for a client with real estate right now. We just don't have enough time, do we?
It's tough, and even when we talk about other assets that maybe we often feel are easier to deal with in real estate, for example, marketable securities, as we get to the end of the year, we're going to have pushback from the financial institutions when we go to them and say, hey, we need to transfer this brokerage account from the name of our client into the name of this new entity that we set up. They might push back and not make that transfer in time before the end of the year.
Yeah, very well said. So the other thing, Trevor, you think about it on these discounts, When you file a gift tax return, and by the way, the discounts are reported on the gift tax return, and it takes an appraisal of our partnership agreement to talk about, what's the value of a non-voting, illiquid asset. And don't you have to check a box on the gift tax? Isn't there a specific question? Walk me through that. What do you have to waive as a red flag to the IRS when you take discount?
Yeah, the IRS asks you, are there any assets that were transferred in the past year that are reported on this gift tax return that were subject to a valuation discount?
Yeah, check the box.
Check the box. And
here's a red flag, IRS. We took a discount. We're doing a squeeze.
And in general, we're okay doing that because we get a professional appraisal from a qualified appraiser that does the report and the analysis and values that interest in that partnership or that LLC, and we submit that to the IRS along with that.
Yeah, we're not worried about it, but what about, we're going to talk about today, the backdoor squeeze.
Yeah.
So what if we have a strategy where we can get it done very quickly in the next month or two? And what if we have a strategy where you're not going to have to check the box on a gift tax return? And so we're calling this the backdoor squeeze. Backdoor meaning we're not coming in the front door waving the red flag with the IRS, we're doing a discount. We're going to come in sometime next year after the gift tax return. And Trevor, what we're going to use, as you know, is we're going to use a swap power. And we've talked about the swap power in our other videos, but basically you create this irrevocable spousal trust, a green box, and in there you put in there that the creator of the trust, the grantor of the trust, as he transfers assets into that trust, he retains the ability later on to swap those assets that he transferred to the trust with assets over here he hasn't transferred to the trust. And as you and I both know, that swap power is essential to make that a grantor trust, meaning it's ignored for income tax purposes. Meaning when you swap assets, no capital gains are going to be triggered. I mean, normally, if I have an irrevocable trust and I have an asset in there and I have an asset over here in a red box and I swap them, that really looks like I sold them. That really looks like a capital gain. So the swap power, now we can put in something very easy right now. I mean, a lot of our clients have $13 million of cash. Right? Right. We'll put that in that trust. We can get that done, real quick. And then we file our gift tax return next year. We don't need an appraisal. We don't need to check the box. I guarantee you, Trevor, there's not going to be an audit on a $13 million gift of cash. It's just not going to happen. So then tell me what happens next year, how we're going to get this backdoor squeeze, because at the end of the day, we don't want 13 million of cash in there. We want 18 or 19 million of marketable securities or real estate or something that's going up in value. How are we going to do that?
Yeah, so what we do is we take the other assets of the client and we continue on with our planning, and we create that entity that we were talking about, a partnership that has non-voting interests in it, and that's going to be subject to those discounts for lack of control and lack of marketability.
Yeah.
And we fund that partnership with other assets. So maybe the client puts in 30 million of assets into that partnership that doesn't take into account this 13 million of cash that's in the green box.
Yeah, this is real estate that we got bank approval from the mortgages and we got partner approval on the partnership. Yep. And now we've got all next year to figure that out and get our discounts.
We can figure that out, and then what we do is we've got 30 million of assets in this partnership, and we go to our appraiser and we say, appraiser, we need to know what piece of this partnership equals $13 million of value.
Yeah, when you consider the lack of control, lack of marketability, all these discounts.
So we get the squeeze.
And so we're going to get an appraisal still.
We're still going to get the appraisal.
We're going to hire the appraiser.
Because on that swap power, the trustee has a responsibility to make sure that what goes in is equal in value to what goes out. And so if we've got $13 million of cash inside of that green box, we need to make sure that we're transferring into that trust something that's worth $13 million of value.
Yeah.
And so we get the appraisal, and the appraiser is the one that says, that maybe it's 40% of that LLC, is equal to $13 million. Then we take the 40% interest, we transfer it into that.
Swap it.
We swap it out, take the $13 million of cash out, and the client has the $13 million back in his red box.
Trevor, we've got so many clients right now that we're doing this swap power. I mean, you and I are probably more excited about that swap power than anything we've ever done, because we've got these clients that have all these big liquidating events, and we're swapping back and forth, aren't we?
Yeah, and there's clients, Matt, that they may have even set up these spousal trusts or these other irrevocable trusts years ago, and they didn't get the benefit of the squeeze. Or maybe there's assets outside of that trust that are...
We got that client from New Jersey that called you last week.
That's right.
He already had a slat, already had like cash and stuff in there, no discounting, talked about a swap power.
Yeah, so we through the swap power, we're going to be able to improve his estate plan and the tax benefits that come from it. And we can take that squeeze, we can take assets that might be more likely to appreciate significantly in value, and swap them in and pull out the other assets that might not swap or might not appreciate. And we use this power too when there's a client that is towards the end of their life and they've got highly appreciated assets inside that trust.
Oh yeah,
and we
want to step up. Basically, I got to slow you down on that one. That's a whole nother story.
That's a whole nother topic.
They're starting to drool over there. Just don't go off there. But I'm hearing you on that. So Trevor, if we do this swap power and we have to swap these assets, do I have to report that to the IRS?
That's not a gift transaction.
That's fair market value. Fair market value in, fair market value out, no gift. I don't have to report it.
That's right.
No red flag. Nothing goes to the IRS.
That's correct.
Right?
That's right.
Wow.
Yeah.
All the people that are afraid of a discount, do the backdoor discount. You don't have to raise a red flag.
That's right.
Are you hearing me?
Absolutely.
Oh, well, thanks for explaining that, man. I'm excited. All right. Have a good day, everyone.